2026. I'm Tim Quast, and with me is Brian Wilson. We're here with Market Structure Edge, and it's quantitative market structure, the mechanics and behaviors of money behind price and volume data. If you have not done this before, thank you for being here. We are happy to have you here. We share what we're thinking, doing, and observing, and what little we know, and we hope we have a chance to discuss it. I'm going to go first because Brian had to do this last time without me. I had a late change of plans last Thursday. I was in Beaver Creek, and we had contractors here. I'm back in Steamboat, so we were having some stuff done here, and the schedule changed a little bit. So I had to. It was right before the demo, and so I had to hand the baton to Brian and leave Beaver Creek. Anyway, it's all done. I'm happy with what we had done. Anyway, so getting to the point here, I'm going first. That is the point, and I've got really two things to talk about. By the way, the rules are, please ask us questions. There is no dumb question. If we say something that doesn't make any sense to you, please let us know. You might say, by the way, the thing that I hear from people is, well, if this data is so awesome, why would you share it? Why wouldn't you just use it yourself and run a hedge fund? Well, I'm not a hedge fund guy. We're data people. I've done this a long time, data analytics. So has Brian. We've known each other a long time, since college, Brian and I have. And, he was a long-time buy-side trader, and we have done this together a long time. We have other team members, of course, and we like data. This is what we do. My aim always has been to help public companies and investors understand how the market works and what the money is doing, because neither of those are doing what you hear all day long on CNBC. Great case in point. Saw the CEO of Workday on CNBC this morning. And of course, he's frustrated. Why are they not being valued for the kind of enterprise growth and returns that they're delivering? And he's talking about the story. And I know the IR guy at Workday very well, know the CFO at Workday. And I sent a note to him and I said, you're missing the point. You could tell your story till you're blue in the face to investors, and it won't create shareholder value if those investors are not net buyers. All that matters is, what is the money buying, which is what we're going to talk about. And what is that money doing? Well, all you have to do is look at the numbers. What happened to Capital Group over the last 5 years? They've had $250 billion of outflows. How about BlackRock? In 2025 alone, $700 billion of inflows, half of that into equities. All right, that's what the money is doing. So if you're a public company and you're not doing what BlackRock buys, good luck, because that's where the money is. And this is what we talk about. We want to go where the money goes and not go where it's not going. And fortunately, that stuff is measurable. Okay, so I've got two things to talk about. One is there are three things to be doing all the time. You could trade short term, you could invest long term, or you can sit out. The question is, when should you be doing those things? That's always the hard part, right? So to me, the trade short term, I'm going to look at that briefly here, and then we'll get to the other two. Let me share my screen. Let me get rid of that. I want to come back to that. Let's go so I mentioned this. I was on with the pre-market prep guys. And of course, our model portfolios pick this stuff up. Our daily trading ideas pick these things up. But let's just take GOOG. If you're trading short term, what do you do? How would you do it? When would you do it? Well, at any time, if you have a stock like Google that is at a 10 where the demand is hitting the ceiling, look, you could apply this to anything you like. If you want to trade Tesla, we'll talk about that. Whatever it is, what you want to do is trade it when the probabilities of returns are in your favor. And so, I noted to the guys on pre-market prep, and the market was down with new options trading context. There's always a reason for it. And it was down most of its volatility. Well, what's the probability that it will produce a return for you of 2% or more? Statistically very high. We calculate that. What's the volatility of SPY on average? Think of that as a proxy for 90% of market cap. It's 1%. What is the market doing? Anytime it's up about 1%, it's the full range of volatility. And it probably has a lot to do with derivatives. But my point is 1%, then the basket is 2%. Momentum stocks, 3% or more. I'll show you one of those. And so you could have a very high probability at the end of the day, yesterday, or was it Monday? I guess, or Tuesday. Tuesday, that's when I was on. Tuesday, I said at the end of the day, if you buy it, last 10 minutes, the probability, no matter what is occurring, is very high that you can make 2% or more. What happened? You can go look it up. Now it would tell you to leave. No matter what it's doing today, you always have a reason. That's short-term trading. It's using probabilities. Demand is an algorithm that meters all of the behaviors in the market and says, how is it affecting midpoint prices? Because 90% of trades are derivations of midpoint prices. These are just things that mathematically we know. So when would you not trade short-term? I want to show you one other thing because ASTS, maybe it's in there. I think it is. Let's go over here, go to daily trading ideas. It's all there for you. Machines do the work for you. You don't have to hunt around. You just take the one at the top of the list and go, you know, yesterday, I think it was, or it was probably Tuesday. So gives you a probability. Nothing's 100%. It's just that in the trailing data, this was 100% true. So if you have an entry point in this range, follow me here. With demand at 10 and supply declining, what is the probability that you can generate a return of some portion of its volatility, which is about 9.5%. It's skewed because of some big moves here. Well, very high. Go look at it today. You know, so yesterday, if you bought it down, you know, half of its volatility, and then you sold it today up all of its volatility, that's what you can do. Now, when should you not do that? Well, there are core signals. If we look at these portfolios and go, well, there's 25 in that and 14 in that, pretty good. If there are 30 or more in the combined momentum and low volatility portfolios, we know in the next 1 to 5 days, those conditions remain generally true. If those numbers drop, then that's a signal. Broad sentiment. If broad sentiment is doing what it's doing now, and look, we can get big moves with derivatives. By the way, we noticed too, we just got biased, but the options dates for 2026, that it's just a subroutine. You know, it didn't get kicked off and it had to be manually repopulated today. So that got that taken care of. Anyway, those little green squares give us context. You know, that will change outcomes. We are so dependent on derivatives that can have a big effect. But, you know, demand is peaked, supply is declining. That's a divergence, generally good for the market, but the market's at the red line. And this has run its cycle. You know, I'd look at this and say, all right, well, now around options expirations, this may become number 3, a time to sit out. You know, the short-term trading, always opportunities unless there aren't. Long-term investment, again, I think about our model portfolios that they do a great job of giving you good things to focus on, and they've been a challenge. No question, since November 25th-ish, when our focused low volatility portfolio peaked for the 70%. I mean, it did really well. And it had no more volatility than SPY. That's the beautiful thing. It stopped working. And I think that it's true of a lot of things. I want to show you one item here that is in context of what we're talking about. Yeah, here it is. It's interesting that if you were to in this context of when do you switch, you know, if you're doing longer term investing versus short term trading, when the conditions that produce returns decline, probably a good reason to stop doing them. If you could take Tesla. So Tesla from September 11 through the 20th. I just looked at this. It defaults to a 90-day view. If you bought the uptick and sold the downtick, you could produce exactly the same return as if you had bought and held Tesla. But the beautiful thing is you could do it in 49 days instead of 90. That is alpha. If you can produce the same return as everybody else in half of the time or 2/3 of the time, that is alpha. And what's fascinating to me is if you look at the segments that this is Profiler, our back testing engine blunt instrument, but it will tell you, okay, the stock ticked up on the 12th of September, and I could do the drop down and show you them all. And there were 12 days in which you would have held it, and then it ticked down, and you sell it, and you make 12%. The next time, not so good, lost 30 basis points. Next time, made 9% in 13 days. Next time, lost 1%. Next time, lost 6%. Okay, we're out. Stop. Right? And it's so interesting that the change occurred November 25th. All over the market. I don't know what it was per se. I can tell you what all the patterns look like. There's the largest pattern of passive change in SPY in the entire data set there, because we track those things behind the scenes. I can't tell you absolutely. I believe that the capacity for money to get out of stocks is very difficult. It's because the market doesn't have great liquidity, and that we have increasingly relied on derivatives. Can I have a basket of options and futures instead of the underlying equity position? And then we see a declining demand for equities, and yet the broad measures continue to rise. How isn't it discordant? Well, yeah, it is. And it's unsustainable over the long term. I don't know when that resets. I'll show you one other thing that relates to this. Trade short term, invest long term, and sit out. And when the conditions like this change, maybe the best thing to do is to sit out. I like to take gains, not chances. Every now and then I gamble. I'm not a gambler, but I've done it because of an expectation that there would be a second shoe to drop from what happened in April. There will be an end to that. Now, I've been wrong. I've lost money each time that I bet at options expirations on a market top and maybe rising demand. Here's what I want to show you in this pattern. I made a bunch of money and gave it back. Bunch of money, gave it. Even the couple of days ago, I made $10,000 and gave most of it back. Because my expectation is that there would be a break. And those are shorts and volatility trades. And they're dangerous. I do not recommend them. I do them because I have some money to play with, and I think that this is going to happen. I can be wrong, and I have been wrong. What is fascinating to me is this is broad sentiment, and it's demand and supply versus the price of SPY. And if you look, this started July 31st, month-end options expirations. Wham, a big dip right at options expirations, and supply had been declining. Happened again at August options expirations. Wham, what's that? Supply was declining, and everything recovers. We get to September and October, this month end, right into that, all of a sudden, wham, we get clocked, that October 10 flash crash in Bitcoin. The market got clocked. It was one of the most volatile days in the entire data set. And it recovered. And then we get to November, and I think I was up $40,000 or $50,000 on my bets, and I gave most of it back. Because of this, I thought, okay, well, now here's the break, here's shoe number 2, didn't happen. And all of these things tell me that there is an over-dependency on derivatives. Somebody will be on the wrong side of that, could be me, or on the right side of it, could be me. And this is what happens. So if you're on the wrong side, you have to cover. If you're on the right side, you make money. And how long does that go on? I don't know. Don't know. Same thing happened here. Options expirations, a big boomerang, a snapback. I wrote about this back in the summer, the blog called The Snapback. But the same things keep repeating. How long can that go on? I have no idea. We know in the patterns that from this point, in fact, it's off the chart here. It's back April 16th was the last time that demand was below that green line, an entry point. That's really remarkable. It's the 191 or 2 days as of today. The longest period we've ever recorded was 208 days in the great pandemic boom. That was fueled by free money, central bank money into people's accounts. We don't have that now, but we have a tremendous overextension of the market with derivatives. What's interesting is, this is point number 2, bringing this around to a historical perspective so I can hand this off to Brian Wilson. How does one think about this from a big picture perspective? Well, to me, our period, and there are good things and bad things, and I'm neither a bull nor a bear. I just know that we are stretching the very limits mathematically of a cycle. It's like I'll refer to the tulip mania of 1634 through 37. The New World brought a lot of unexpected wealth that increased the money supply, and it flooded into Holland, and it made its way into speculative endeavors. Futures contracts were created to trade on tulip bulbs. Everybody was betting on everything, and it worked till it didn't. You could take the Mississippi Company in the early 1700s, and I've read 2 books about that and studied it, of course. I mean, it's monetary policy. As Millionaire is a worthwhile book. I've mentioned it before about John Law. I mean, he had an interesting idea. The French government was in trouble. Could we do a restructuring, a debt for equity restructuring? Could we sell the public an interest in the Louisiana Territory and then wrap the Bank of France into it with the promise that this Louisiana Territory would produce tremendous gains for France and it would offset their tremendous debt from the wars that they'd engaged in? And at the beginning, it worked. Coachmen got rich. They buying this stock and selling it at huge appreciation. They bought carriages, and then they had staff, and everybody was redecorating and eating out in fine restaurants, and it was boom times. And then it collapsed. Step forward, you could see, from 1918 roughly to the late 20s, there was 100% inflation. The country went from $2 billion of debt to $27 billion. The first time we had explosive debt because we created the central bank, 1913. And everything boomed. There was tremendous inflation. Now, I know Ben Bernanke has a different view than me. We didn't provide enough liquidity. To me, there is inflation and deflation. They always follow each other. It is axiomatic through human history. And so I would say we're in a cycle again. I don't know what that is. There's Bitcoin and AI and all kinds of things. Boom. And when you're in the cycle, you don't know where you are. It's just the ceiling. You can't step outside of it and go, oh, this thing is up and this thing will come down. You don't know. Now, because I can look at this from a historical perspective, I will be both right and wrong. Do I think we're coming to the end of it? Yes, but I don't know when, which leads back to how do you approach this? How do you look at it and say, well, I can trade short term, I can invest long term, or I should sit out? And it depends on your risk tolerance. I look at these things and go, I don't know how, maybe we can go 300 days. I don't know. Maybe we can go 20 times repeating this cycle before it snaps. There are only 2 things that will break the market: a change in flows. We had it. That happened November 25th. And a break in the arbitrage mechanism. Haven't had that. When I say arbitrage mechanism, the market is comprised of stocks, ETFs, and derivatives on both. They all have to be kept closely aligned, generally. Otherwise, no one knows the price of anything. ETFs all depend on an underlying basket. And all of those things are priced by machines. That's interesting. Machines price the market. The money coming into the market generally runs on models, not exclusively. It's just the central tendencies. And so if the capacity of the machines to determine how to calibrate prices diminishes, and it can for short periods of time, then you get sudden snaps. And one of them will break. I just don't know when. I'm not bearish, but I look at this and say, well, which would it be? I'm less inclined to invest long-term here. I'm more inclined to trade short-term. And much of me is sitting out because I just think we're getting near the end of the cycle. It's very interesting that you look at, we're at record low levels of cash. Everybody's bullish. It hasn't been like this since January of 2018. Well, go look at what happened in February of 2018. Again, I'm not saying that's going to happen. I just think history is a really good teacher. And it's good to be, aware of what occurs and to be cognizant of risk and to be deliberate in what you do. And, we try to do that with math. So that was a lot of ground that I covered, but these are the things that go through my mind. That's all I've got except for what's next. Yes, please fire away, everybody.
I'd like to quickly ask a question on the history of the big portfolio. One of the sub portfolios, big tech, doesn't have the history, but sometimes it drops below 4 or right at 4, where the broad market does not. Have you thought about providing that history and doing some analysis of the buy-in for that subcategory of big tech?
Well, absolutely. And we behind the scenes, Chris, we certainly think about it all the time. It's a constant debate. I mean, look, you could say, is is that the threat? If the market is so dependent on that, should we just
Yeah.
focus on that measure? And it's a great point. I was certainly pounded the drum. I said it on CNBC that I felt that there was a major problem in that the benchmark was massively outperforming the underlying basket.
Mhm.
And now it's reversed. And, would big tech help us understand that? Maybe. I mean, if we could, my challenge with it is, we put 11 stocks in there because we throw a couple of others in there that to us are like orbiting planets that we like to keep an eye on. But should we use 7 stocks as the benchmark? It might be right. It might be right.
I'm not saying using it as a benchmark, but as a category with a little more information on it. Yeah.
It's a good idea. It would be interesting to overlay it, wouldn't it? Just
Yes.
to show that
Yeah.
line. Yeah, it would. We'll look at
Thank
it.
you.
I'll talk to the engineers. Yeah. Appreciate that, Chris. Okay, anything else before I hand this up to Brian? Candace, you look like you want to say something. No? Okay. Let's see. Let me check that one. The edge portfolios. Oh yeah, I will, because look, I don't like this either with the model portfolios. The fact that we have changed them. You look like you don't know what you're doing. You're like, well, is that going to work? That's not how we want to appear, nor is that what we're doing. We track standard deviation. And we say, so long as our standard deviation in our portfolios is edging up, meaning that we're outperforming, great. When that deteriorates, then we have to shift horses. And it got very hard. I cannot find a good horse. And that made not even a slow horse, which is a good series, slow horses. And the books are good too. But and that tells us that could be the sign to say maybe we should just sit out. It's been very difficult. Momentum is working again, but again, I'm queasy. I'm queasy, It's but let me see what the question was here. Okay. Sev, thank you. Thank you for that. Good to see you, my friend. Let's see. What am I missing? Can you talk 5, then 3? It is, unless you're right. I don't like it either. It's like we don't want to just yank a portfolio. And we wanted to make sure that we were using 2026. We started with a little history, so people would know, but now we're benchmarked from 2026. I would prefer to stick with what is known, and we have. It's momentum and low volatility. We've always said, can you go where money is, where there is excess demand, or can you go where there's a high probability of outperformance with limited risk? That's what those two are supposed to do. And both of them struggle from October 31st to a week ago, very challenging. And the contrarian, we looked at the data and we just found complete correlation, nearly 94% correlation between the performances. And we went, okay, well, I guess we should put that in there. We don't want to be George Costanza, right? But that's what we thought, well, if that's where it is, that's where but we pulled it, right? I agree with you. We pulled it. We can't live with that very long. Okay, Brian, sorry.
Tim, one question from Brad. He's having some issues with broad sentiment on one of his views. Maybe you can read the question.
Okay, let me see, Brad.
It might be okay now.
It shows 68 days. Well, no, Brad, I think that you're having some caching issues. It's one of the things. I had a conversation with the engineers today. We use Redis cache, and then there's it's the built-in function within Azure that we're using Azure Blazor, and it's meant to interact with. We did it on purpose because of there are all kinds of browsers, and they present a tremendous challenge for display. I'm sure that's the issue, but because we can't reproduce it. If we could reproduce it, we would know there's an issue. I did alert our chief engineer to the Safari issue, and we'll look at it. 3 years ago, we had some real Safari issues. Haven't had an iota of an issue since, but we'll see what we can do. I know that's the problem. It's caching. There's no issue in our data. I have a standing meeting with our engineers right before this, so I'm always talking to them. Okay, Brian, yours.
Cool. Thank you. Great to see everybody. Thanks for coming along and joining us today. Couple of topics to discuss. A couple of these will kind of dovetail a little bit with what Tim has been mentioning. Wanted to start with context, and you can do this yourself if you're interested. Just go to resources and then go to the expirations calendar. And this is one of the things that really I learned from Tim when I started working here. I was a buy-side trader, but I didn't even have some of this knowledge, or I wasn't as in tune with it as I should have been. So here's the planning calendar. You can see the bottom tells you what everything is. I just wanted to make a couple of points today as we're walking through this, and Tim and I in our daily notes try to keep you updated, but you can kind of look ahead yourself and see some of the key events. The ones that you really want to be cognizant of, that's options expirations. You can see it was different here in January. What I mean by that, this is the normal cadence. This is VIX expirations here in green. So volatility expirations. And the normal cadence is just 3 days in a row, 3 days in a row. And once a quarter, you'll see that in a different rhythm. We had the different rhythm this quarter. And part of the issue with what we saw on Tuesday, obviously, President Trump, Greenland, tariffs, it's going to impact the broad market. But all of that was occurring right here on the 20th. What was occurring on the 20th? Well, it was the last day to trade January volatility expiry or volatility options before they expired. So you had market participants, all of a sudden volatility increases and they've got to do something about it. So you get this amplifying of volatility. When did it occur? Well, it occurred on a context event. And to a certain extent, yesterday's trading was similar. Midday, we have positive news regarding tariffs. What happened to the market? Well, the market takes off. What's happening in the background? Well, the market is shifting its focus to the February volatility series. So in the background, things are occurring, especially around expirations. I would say the other one that really take note of, a lot of times month end is becoming that way as well. So just from a context perspective, you can kind of look ahead yourself. We do try to give you a heads up, but just be aware of some of these things. Expirations itself, really, those are the things that I really think about. And I think I've mentioned this before, but if I'm going into trading, let's say on January 16th, at the end of the day, I'm going to try to be as flat as possible. Why is that? Well, this is almost like a balance sheet. It's like a point in time. So we get to trading on the 16th, and that expiration series has concluded. Is the next one going to be the same as this previous one? I don't know. I have some hints, but like I said, that's one of the areas where I'm going to be a little bit more careful with my trading, because I don't know what the market's going to be when the focus then shifts to the next option series. So just wanted to point that out from a context perspective. Wanted to share something regarding year-to-date leadership. So this is what it looks like right now. This is as of yesterday. We've had some really strong sectors year to date. Some of my clients on the IR side are in some of these sectors. They're just exploding higher here at the beginning of the year. Great lesson regarding the market, though. I mean, look at these 9%, 8.5%, 7%, 6%, 3%. What's the broad market up? 52 basis points. Why is that? Well, it's because of communication services, which is down, tech, which is down a little bit, and the financials. Where is most of the market cap in the market? Basically in these three sectors. So it's a good, lesson. You'll hear it talked about on the press, kind of a broadening out of leadership in the market, et cetera, et cetera. Well, it's good if you happen to be in those particular sectors or a particular company within those sectors. If you're looking for the broad market to advance at the same time, that's difficult. And this is a great lesson here, how dependent the market is on big tech. So I just wanted to share that with you. In regards to where we're at right now, Tim's already talked about some of these points. But when I'm looking at trading, and this is our setup where I'm at right now, just so you know, is right here. So broad market sentiment for risk management, we're above the red line. What that looks like, and I highlighted it in this morning's note, when broad market sentiment moves above the red line, that means that it's 6 out of 10. It's moved above 6. On average, and I won't share the spreadsheet because I think I've done it the last 2 or 3 times, but on average, we spend 9 days above the red line. This is going back 5 or 6 years, and the market return during that time above the red line is 60 basis points. And this is almost, identical to what we would normally see in the market. We move above it, the whole market becomes a little bit stretched. Does the market tend to implode? No, but it just becomes much harder to continue to post gains. And that's what we entered, right in here, move above the red line. Of course, we had tariff anxiety as well, coinciding once again with VIX expirations. Obviously, we've seen a little bit of downside. But if I'm looking at trading right now, this is not the time that I would buy. Let's say I was going to add SPY to my portfolio. It's not a great time to add SPY to my portfolio. I would much rather buy it when it moves below the green line. I have a much better chance from a directional trade with that type of trade. When the market's above the red line, these are going to be more short-term type trades. I'm going to look to the daily trading ideas. I'm going to look to some of those other things. I'm not really looking to add to long-term positions when we're at red line conditions, if that makes sense. Red line conditions, we have just cleared expirations, short-term trades. I think I've talked about all of those. Tim, I'll stop sharing for 1 second. I'm wondering if you can perhaps talk about the model portfolios for 1 minute, and just Tim's done a lot of work on these and kind of like where you've come out right now. I've shared in the past how I kind of approach trading, but maybe how you approach trading in those portfolios as well.
Well, I follow them. When I'm using them, and I'm not using them at this moment, I'm in the short-term trading or sit out, because I feel like the market is very vulnerable to something going awry, particularly because nobody really anticipates it. And again, I don't know. It's a probability. Certainly, I've thought that would be the case 4 other times since October, and it hasn't. So keep that in mind. But when, and the rest of the year I use them, the whole trailing year, they've been really a useful tool to me. I may not engage in the same level of turnover. Like I might do it once a week. If the model portfolio is reweighting every day, I might do it once a week. You might pay some performance cost for doing that. We try to get the turnover down as low as we can. We could force the portfolios to hold 4 things. The whole aim of these portfolios is to give you a manageable set. Instead of 35 components, could you run a portfolio with 4, 5, 6, 7 things that produces a reliable return with, to some degree, controlled volatility? So to me, they work really well because they're easy. Does all the thinking for you. You know, the conversation I had with the guy at E-Trade yesterday, he said, you know, the retail trade, we're retail. That's what we are. we like to be given a plan and a process so that we don't have to think through it and do a bunch of work. And I think the portfolios do that well. I will say again, repeat myself, that from November 25th to present, it has been very difficult to find anything producing reliable returns. And to me, that alone says a lot. And we'll tell you, we'll tell you in the notes. Brian and I are taking care of those. So, we take it very seriously. We look at this data. We're trying to make sure everything that we know, certainly, and that what the data are telling us about conditions. And we'll put in those notes, and we'll put in the market desk notes. We think it's challenging. We're going to continue to calculate those because it's our job to make sure that you have them. But right now, when it's not easy, that's a good sign to tell you. Maybe just, the old cowboy adage I've used a bunch of times here in these demos is sometimes the best way to double your money is to fold it over and put it back in your pocket. And that might be the case for a bit. When the conditions are better, we're going to know. I think we are, of course, repeating myself yet again. There have been repeated times where you'd look at it and say, well, there's the break, and we're going to get a 4.0, a drop below 4.0, and a good entry point. I've got my managed accounts, the advisors. I've told them I don't want to change my allocations to my long-term investments until that happens. And I've sat there and waited for several months. Could I have increased my exposure to the S&P 500? Sure. It's what I have right now is excess exposure to fixed income and much less exposure to the S&P 500. And I'm waiting for that entry point to rebalance them. And I haven't gotten it. And right now I look like a fool, right? Because they're telling me, well, you should have been doing this. So, Quast the idiot is keeping his current allocation. Well, I look at the risk and I remain resolute that the risk is significant. I mean, if the longest period we've recorded, now again, it's not this isn't back to 1900. We have apples to apples data from June 2017 to present. We ran data with a much smaller data set from 2010 forward. Why during this period of time? Because Reg NMS is a unique market. You cannot compare regulation national market system conditions to what preceded it. From 2007 back, different market, different rules, different behaviors. Everything was different. You cannot expect the market to behave as it did in the past if it's subject to different rules and different behaviors. The crash in 1987, we just had gotten electronic markets, and we were really fascinated with electronic derivatives, and it blew up. So we had a flash crash in 2010. That was a product of the explosion of machines in trading. At one point, we were measuring the data then. We were running data, and we were like 75% of volume is coming from Getco, which became firms like Citadel and Susquehanna and Hudson River Trading and so on. And that blew up on May 6, 2010. There were surrounding conditions. We have a very durable market because machines they don't make many mistakes. Software doesn't make many mistakes. But at some point something goes wrong, and so that's why I look at the data this way, and I'm content to sit on my hands. We're going to give you the very best model portfolios we possibly can, and both of us will always say this is what we think. Not advice. We don't give advice. We provide data. We offer our opinions.
And quick question from Joe: what would be a factor that would get you back into the model portfolios? And I can address it first, and then maybe you can. I think from my side, if big tech started to firm up, I think I would be a little bit more committed to going back into a couple of those portfolios.
Yeah, I don't like to buy the model portfolios when broad sentiment is topped. When it bottoms, I'm happier. The thing right now is we've had this about 7-day decline in short volume while the market is topped. Usually they move I mean, well, I showed you the pattern, right? So that repeating pattern with the same thing occurring, whatever it is, 6 or 8 times. So I'm not gonna there. It looks like everything's going to do just as it's done before, but I don't know. Tomorrow's another day. And so I'm going to stick to what I do. I go long the portfolios when all of the conditions point to it, including broad sentiment. And when it doesn't, then I'm more cautious. When I can look at our data and say, wow, it's pound in the broad measures, I'm all in on our portfolios. When that stops, and that happened, then I'm more cautious. It doesn't mean they're not going to work. It's just that, despite my, proclivity toward betting on tops and bottoms, I'm not a gambler. Okay.
Maybe I can share something real quick. We're coming up towards the end of our time, but just in regards to a couple things on the model portfolios, and I believe I have it open here. So our 3 portfolios, you're looking at focus, momentum, and I'll share 2 charts with you, the 25 performance and then 26, and kind of very quickly go through the different ones. So this is what happened in momentum, and especially in, from November going forward, obviously moved lower the tail end of the year. What's it doing so far in 26? Well, it's the best. It's the best out of the 3 that we have right now. So that's the performance right now. What's the actual performance numbers? That's up 4.4%. If we look briefly at the other 2, this is focused low volatility. Here's what 25 looked like. This was our, barn burner in 25. November, that's where it started tailing off. Lost about 10% at the end of the year, but we still ended up about 60% up by year's end. 2026 basically even with SPY, and then lastly the contrarian fund. I'm not sure if we have a chart. I don't think we have a chart on that one for 25, but this is what we're doing so far.
There is to the far right, and it's not great, but there's the 25.
There's
chart.
There's the chart for 25. And
then, why we supplied it is because of the high correlation that it was showing versus what happened in the early part of the year last year. I mean, it did well when the market wasn't doing well. And so we thought, okay, well, if that's what the data are showing, fine. But it ended.
Yeah, you can see that increase of about, 15% in a very short period of time. But 20, started off the year great, and has been moving down so far, year to date. I'll go ahead.
Those are not criteria that we would generally recommend. They're things that have very low demand and high short volume. And why would they perform during periods of trouble? Because they could end up in a tail risk portfolio. That's all, and so. Tail risk strategies, black swan strategies only work in rare instances. And it's more akin to that. It's not something we're advocating. We have found in rare instances that that's the place that might work, and it's not. I mean, that cycle ended really quickly. Okay, we took you pretty long, right?
Yeah, I'll comment briefly on kind of the path ahead. We've talked a lot about this. But, one part for me, one consideration, does big tech join the party? I showed you earlier what's happening for S&P 500 performance. Before today, it's only been up about 50 basis points because big tech has been lagging. So that's one area for me to watch. Another consideration, once again, this is more of a short-term trading environment for me because we are above the red line. It tends to slow down advances for the broad market. And I think really that's it for me because red line conditions for me tends to mean choppy market conditions, and it means more short-term trading.
Yeah, I've kind of said what I've thought. Broad sentiment's topped. I think the trend in short volume is going to reverse. I think the these patterns that we have observed in passive investment, what we track in volatility, that all of these things, they're ripe. You know, I'm not going to predict that there's going to be some kind of, that'll make you a fool for sure if you're not already. But I feel like the conditions, if I were to look at the data, I could come to the conclusion that it is as vulnerable as it's ever been to some kind of event. And I can be completely wrong. I've thought that twice before in the last year. We'll see. All right, you guys, good to see you. Thank you for the extra time. See you next week.